Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer. So thankful you're joining us as always, giving us a few minutes of your time. And I must apologize here due to some late breaking some logistics. It'll be just me here joining with you today. The rest of the team is busy here, and we just had some meetings come in that we had to take. So I will knock out the points today, and I guess you'll just have to suffer through that with me. Usually we have the excitement of some charts from Andrew or some wisdom from Joe or some of the exciting tidbits from Zach here. But I'm going to boil it together and kind of give you the three big points that we really had from this week's investment analysis. We're going to talk about the valuations that we see in the current mega caps, the theme all year, but want to put some perspective on terms of the price tag in these stocks. I'll take a look at the bets that are going on in terms of Federal Reserve and whether or not they're going to increase rates or cut rates. And then lastly, where we see returns in various asset classes around major Federal Reserve moments. So let's start and dive right into these valuations of large cap stocks. So we're in this era that has been defined and dominated by the S&P for names that we've given them, but they're listed here on the left part of this chart. But there's been really two other major areas in our what I would call recent history that would resemble this, where you have some domination by a handful of tech names. That was in March of 2000. But also, if you go back into the 1960s, into the latter part of that decade, into the early part of the 70s, you had what was known as the Nifty 50. And it was actually very similar and very much dominated by which at the time you can see them here: Coca-Cola, McDonald's, Texas Instruments, IBM, Xerox, and Polaroid. That was your dominating tech stocks of the time frame. And so the interesting part here is that we want to cross compare the price to earnings ratios of these periods. And right now, that is 53. So you just want to put some averages on that. The S&P long-term average. So if you look across the 500 stocks, the average is right around 15 or 16. Kind of depends on the time frame with which you're looking. So 53 is really up there. Now, on one hand, those numbers should be higher, right? These are the higher growing names. So to some degree, they should be higher. But history says, as you see from the tech bubble where the average was 62, or in the Nifty 50 area where they were 56. That doesn't say that there's a certain number where this rally has to ultimately falter. That certainly could go higher. I mean, from 53 to 62 is a nice little extra gain. But I think if you look at it from a more risk managed perspective, all right, the odds are that we really need to keep our portfolios diversified and not be over leveraged to those names. That those of you that have been with us know that is the case. And you'll also know that it causes us to at times lag what you would have had if you were overexposed to the S&P 500. So this is just one more thing in the theme where we do worry about investors who are often too concentrated in those portfolio names, particularly in 401ks. So in the next chart here, we're going to shift gears and talk about interest rate futures. So SOFR, that is the acronym for the index that took over for LIBOR. All right, the rate that is used to often price commercial loans or sometimes even mortgages. SOFR is that instrument that has replaced that. And traders, hedge funds, or investors of many institutional types can bet or have futures positions on SOFR. In other words, if they're taking these long positions in this contract, that means they are betting on interest rates to go down. In other words, their futures position would appreciate. Conversely, it would be the opposite if they were selling these contracts. And what we've seen as of late is a massive appetite for these contracts. And that is essentially saying the hedge fund traders are betting on rates to drop. That doesn't mean that they're right, but it does give us a growing sense of concern that investors are getting a little bit too bullish because we are just now past or just right past the last Fed rate increase, and they're not officially done with their rate increase regime. Now, I think essentially they are, and I think the highest weighting of the odds would say that they are done raising interest rates, but it's interesting how quickly the investment community has bet on to cut. So we have to worry about how our portfolios are positioned. And right now it's moving towards the degree where people could be surprised if the Fed shows any sort of resolve, like they have many times in the past, that, hey, they're just not ready to cut rates yet. There could be some painful losses in these contracts. And it's a reminder, as always, we do stay very active in our fixed income portfolio because this outlook changes all the time, and we want to be tactically adjusting to that framework. And lastly, we're going to take a look around this in terms of when Fed is raising rates, when they stop, and where those returns are. And so we got two panels here. On the left panel, it's going to show you various returns for the S&P 500, treasuries, and then the Russell 2000, which are small caps. And then the right panel will show you where we are today. So the left panel will say as what the averages are. So the dark blue on each of these. So let's just take a look at the S&P 500. That dark blue represents if you were to buy when rates peaked, all right, when the Fed set the last interest rate hike in a cycle. The blue then indicate the next move when they cut. You make your buy then. And then the last part was if you bought 3 months before the peak. And in each of these cases, the best time to buy is right there at the peak, not when they actually cut rates, which can be kind of counterintuitive because we often think in an analog sense, hey, if the Fed's going to be cutting rates, isn't that the time that we want to be investing? And the answer is historically, the market beats them to the punch. And you want to be involved before they get the case. And that, to a large extent, is what we're seeing in these last several weeks. November was certainly good. Here in December, we're taking a little pause. Andrew spoke to that probability last week in the market, digesting some of these. But I would say right now it's kind of not exactly lockstep each step of the way in with this theme, but it is market moving, I'd say, to price and get in just, I'd say, before there was a rate cut, because I know once that happens, a lot of the gains have already happened. So, hey, those are the 3 points that I have for you this week. I am so thankful you gave us your time. As always, we'll give you a reminder here to give us a call, 800-928-4001. Or if you scan this QR code, it will allow you to book the appointment electronically. So once again, thank you, and I hope you have a great weekend.